Good morning, welcome to the Australian Early Finance Briefing for Friday the 25th of September. My name's Nick here in Melbourne. Starting in the US, and Goldman Sachs has revised down their growth forecast for Q4 significantly. They've slashed it in half, and they've also bumped their growth rates up in the Q2, Q3, Q4 of next year. Now, there's two main reasons for these adjustments. Firstly is the big hit they see emanating from a lack of the second round of fiscal stimulus from the US government. They were expecting in their base case that there would be $1.5 to $2 trillion in stimulus being passed by the US Congress shortly, and now they see that not really happening till Q1 next year. What they say is, we think it is now clear that Congress will not attach additional fiscal stimulus to the continuing resolution. This implies that after the final round of extra unemployment benefits that is currently being dispersed, any further fiscal support will likely have to wait until 2021. They're saying that the Congress is more distracted by filling the Supreme Court seat than passing the fiscal stimulus resolution. So they go on further. Goldman says withdrawal of fiscal support will reduce disposable income in Q4 to roughly the pre-pandemic level. This will obviously weigh on consumer spending, but they don't see it being quite as bad as initially feared in earlier forecasts. That's because they're seeing ongoing adaptation and reopening in the US service sector, and they're saying that this reopening can likely continue to at least some extent in the coming months, and we therefore expect softer but still moderately positive consumption growth in Q4. Now, as a result, they've sort of moved their growth further into next year. So they've increased the Q2 by 1% and then another 0.5% to Q3 and 4. They haven't changed anything in Q1, and that's due to the vaccine. Now, as we mentioned in previous episodes, that they had forecast that the vaccine would be widely available to the US general population from early Q1. They're now thinking that's going to be more Q2, and that's due to recent press reports that the FDA is likely to announce tougher standards for vaccine authorization, although Trump has hinted at sort of revoking those. But that's largely going to shift growth to later in next year. Moving on to ESG investing now, and the FT is reporting that the big four accounting firms have come together in a joint initiative to unveil a reporting framework for ESG. Now, this is spearheaded by the International Business Council, which is a large group of 130 sort of global companies, and it's led by the CEO of Bank of America, Brian Moynihan, and it's also got sort of buy-in from the World Economic Forum. So this is a new framework that has 21 core metrics and 34 extended metrics covering issues ranging from emissions to social factors such as pay and gender ratios and governance targets. The FT points out while environmental factors are being measured by some companies, social metrics are considered harder to measure with precision, and some leading accountants warn it could be hard for US companies to report on social metrics since that could raise potential liability risks. But this is really positive, and it's the first time we've seen the big four come together. As the head of Ernst & Young say, this is the first time we, the big four, have done something like this. Bob Moritz, the head of PwC, says society's struggles have only got worse with COVID, and the only way we solve these problems is to get the capital to the right places. We need a framework to help investors get the information they need. Now, there's obviously lots of other initiatives going, including one of the big ones from the European Commission, but this is the first one that's got all the big auditing firms buying into it. And moving to the markets now, and about 50 minutes after the US Open, Nasdaq's up the most, about 90 bips. The non-tech names aren't doing quite as well. The Australian dollar continues to weaken, down closer to 70 US cents. And that's your early update for Friday. Have a great end of the week.
This podcast is for investment professionals only and should not be relied upon by private investors. The podcast is provided for informational purposes only and does not constitute financial advice. The values of investments can go up or down, so you may get back less than you initially invest.